Good morning. Today is Tuesday, August 13th, 2024. I'm Joe Terril, president of Terril and Company, private wealth managers located in St. Louis, Missouri. With me today is Russ Phillips and Dave Carter, and this will be an update over what has certainly been a very volatile last 3 weeks. And it fits in with how volatile really the markets have been in the last 3 years. Russ, I want to ask you because I'm aware of the fact that stocks have been very mediocre performers in the last 3 years. And I'm not so sure that the investing public understands that stocks have not provided robust rates of return. I know you're our resident statistician, so to speak. Give us some of the figures, will you, please?
Sure. Thank you, Joe. As you know, I think what you said is on the money. If you go back to January 3rd of 2022 through August 12th of this year, so 2.5+ years, and you look at the annualized returns of different indexes. So for example, the NASDAQ 100 is represented by the triple Q, has an annualized return, again, January 3rd of 2022 through August 12th of this year of 4.5% annualized return. The S&P during that same time frame, annualized return, 4%. There's about 2 interesting notes. The equal weighted S&P during that time frame is actually annualizing for 2.5+ years, 0.7%. Joe, I know you like the Dow Jones Industrial Average. It's under 3%. Small cap stocks actually have returned on an annualized basis about a -2.4. More importantly than that equal weighted RSP, bonds, which I know David will talk about in a little bit, bonds on an annualized basis as represented by the AGG have returned down 4.5%. So if you've been an investor that has been 50% in a diversified equity portfolio, 50% in a bond portfolio, a lot of clients, Joe, we know are in bond mutual funds, they're safe money, they're losing money. So at best, over the last 2.5 years, if a client has not pulled money out of their account, they're probably flat to slightly down. So you are correct.
Well, we're very proud of the fact that our performance has been better than that. We select individual stocks for the most part. We select individual bonds, not bond funds. Consequently, our individual bonds have performed much better. We've stayed very short with maturities. So the message I'd like to get out to the public is the fact that there are time frames when stocks can be a lousy investment, and that period can go on 4, 5 years, 7 years, 8 years. And I believe we're approaching 3 years now. Looking forward for the next 2 to 3 years, I think we're going to have to be very specific on stock selection, or you're going to continue to have these very poor results. I think this moves in the market is going to be another 2 to 3 years before you can say stocks and or bonds are a relatively good investment. And I think that comes about because when interest rates went to zero, prices went too high. They are correcting and they are coming back in line, but I believe this will continue. Dave, I want to switch to talking about what we're trying to do in client portfolios in fixed income land. Tell us maybe what's happened in the last month with fixed income and what we think is the best place to be structured right now.
Well, thank you, Joe. And again, the fixed income market has been volatile, and there's this expectation and growing expectation that that interest rates are coming down. And when I talk about interest rates coming down, I'm specifically talking about Fed funds and what the Federal Reserve has control of. And right now the market is pricey. Fed funds are effectively at 535 right now, and the market is pricing a 1.25% decrease between now and maybe the end of January of 25. So that brings them down to maybe 4.25, in that area. Still, you get the impression that the market talks about lower rates, meaning lower rates are going back to where they came from, which were very, very accommodative, zero. That's not happening, and in our opinion. And what we're trying to do is, again, individual bonds where we know we get paid our coupon on X date, we have our principal come back to us on X date, and it's very finite as to the terms of the bonds. And we're out 18 months to 12 months to 18 months, and had been fortunate to put a portfolio together yielding about 5.5%. Now that's going to become a little more challenging as rates come down, as we talked about, but saying that there are opportunities, selected opportunities in bonds that reset their coupons, that we can buy at discounts, that we get 6% plus until the reset, and once the reset happens, we get a higher coupon, and we like that. We like that dynamic.
We've been buying the callable preferreds, a preferred stock being a very good income producing vehicle. And these preferreds, I know you and I bought another 8 million worth yesterday. We're able to buy these preferreds to call dates at almost 7%, and in a few cases a little bit ahead of 7%.
True.
Our idea there being that we'll make 7% for 18 months, and at the end of that time frame, then we'll worry about where to go. And for individuals, some of that 7% has tax preference items that make the after-tax return even higher. So, talking yesterday, Dave mentioned the fact that these various futures markets that are a way of predicting what Wall Street thinks is going to happen with interest rates. True, Dave, that those markets believe long-term rates are not going down, only the short-term rates?
That's correct. From what I see in the futures markets, and I have data. I look at the 5-year because 5-year is a important financing rate for commercial banks and commercial bank customers. A 5-year right now is say 4. Or I'm sorry, say 346, and going out into 27, it's 350 on the futures curve. Same thing with the 7-year. And you take a look at the front end, the Fed funds futures, and they're down at 3, maybe 3.5%. So you're seeing a steepening of the yield curve, which should be very positive for the financials.
Let me chat a little bit about the economy, and then Russ, I want to come back to you for one more thing about the stock selection. But on the economy, there have been definite signs that perhaps the economy is slowing based upon the consumer slowing down spending. This is not definite, but certainly it's a trend that's been occurring. We are not ready to say this is going to happen and therefore we're going to have a recession or the economy is going to only grow at 1%. But we are monitoring that very closely to see what the consumer is going to do over the next 2 to 3 months. Because along with that comes inflation. The inflation figures have been coming down, but we're a long way from being able to say inflation is going back to 1 or 2%, and more importantly, staying there. So we are monitoring these things every day with all the economic news that comes out. Because Russ, switching back to stocks, subject to what the economy is going to do, and I know we tend to like at the moment, the value stocks a little bit more, particularly ones that are good dividend payers. Just chat about small cap versus large cap, technology versus value for a few moments in what time we have left.
So one of the things our committee, Joe, has discussed is moving forward in what could potentially be a slower economy is you want to focus on quality. You want to focus on balance sheets. You want to focus on larger cap names that pay dividends. We believe you want to stay away from the glamour names, as you call them, Joe. And we honestly feel that the glamour names could maybe have seen some of the highs for their cycle. So sticking to quality balance sheets, dividend payers, perfect example of a name in our portfolio or names in our portfolio that have done well that fit that narrative, AT&T and Verizon. So those are the type of quality balance sheets, quality companies that are on sale, paying good dividends that we're focused on in the portfolio.
Yes, some of these dividend yields, we've been looking at Pfizer. We haven't committed to it yet, but almost a 6% dividend yield. A stock like AT&T certainly is the opposite of glamour, but we don't particularly care. All we care about is the rate of return. And the stock's gone from 14 and change to 19 and change, plus paid us over a 7% dividend. That'll provide a nice rate of return. Maybe not exciting, but at the end of the day, it's how much money do you make? And it's working well for us. And we have other ones like that we think we can add to the portfolio if we can catch them at the correct price. So maybe with that said, Brian Curtis, our producer of these videos, let's end it right there. And we'll be back in another 2 to 3 weeks with an update. Thank you for joining us.